The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Defiant equity traders get rewarded while the bullish bond investors get disappointed. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Bonnie Quinn, and we are kicking you off to the closing bell right here in the United States. So let's take a look at those markets. It's been a fairly choppy week, a down day yesterday for the equity indices, but they're roaring back again today. The S&P 500 up 0.7%. Lots of positive sentiment out there, not least the idea that there might be a reevaluation of the OpenAI valuation, for example. Also, lots of other interesting tidbits out there that we'll bring you throughout the next 2 hours. The Nasdaq 100 up 1.25%. We're positive on the week, even with that down day yesterday. But look at those yields, because we are still below 425. In fact, we are below 422 right now on the 10-year yield after that auction. Fascinating that yields are not reacting like equities are reacting, and the dollar index continues to be weaker. It is to the helpfulness of sterling and the euro today, Romaine.
Yeah, we're going to talk a lot about the intersection of what we've been seeing between FX, between yields and the equity market, because that pushback toward record highs for U.S. stocks really is emblematic of the defiance of late by equity traders. Traders increasingly willing to look past our economic data, look past the recession risk. And Goldman's main macro trader, he says, well, there's a good reason for that. Strong liquidity and even stronger structural growth themes around AI. And that's given trend following investors control over the hot equity flows.
I don't think that the markets are ignoring recession risk. I believe that the markets understand that there's a healthy component of downside risk possibility, but there's also a healthy component of upside risk possibilities too.
And there you heard it, upside risk. Of course, that is the risk of missing out, and that's on display today in a big way with big tech. The biggest lift in markets coming from the biggest big cap laggard, Apple. That stock right now on pace for its best day in 3 months, ahead of a planned announcement by Tim Cook at the White House that the president front ran. That's coming this afternoon, with the iPhone maker said to commit $100 billion more to domestic manufacturing. We'll have full coverage of that in the next hour. In the meantime, we are looking at equity investors exuberant, dancing, if you will. Meanwhile, bond investors are singing the blues. They were positioning for a rally in Treasury prices that would push yields lower in anticipation of those Fed rate cuts. But that inflation data isn't cooperating. And Kevin Nicholson over at Riverfront just yesterday, he told us there's little attractive about current yields, and that was a sentiment that played out in the latest 10-year Treasury auction just a couple of hours ago, Bonnie. One of the worst auctions that we've had in terms of demand in about a year.
And we have more to come this week as well. It'll be fascinating. And to your point, Romaine, let's have a look at rate cut bets, because they have been, quote unquote, all over the place all year, if you like. But on any given day, they are in a very specific spot. And right now, we have seen the ramp up, the downward slide, if you like, of this chart showing the ramp up of cut expectations. And we're now at 61 plus basis points again, having seen this big ramp up here just since that weaker labor market report. And Romaine, you also mentioned Paolo Schiavone's note over at Goldman Sachs. Very interesting that he's pointing out that, you know, there is a 30% recession risk priced in by Goldman's economists, and the market is ignoring what would normally be a red flag, because it seems like betting against this market right now would be madness.
Yeah, absolutely. It feels like right now the fixed income market a much tougher tape to try to trade than the equity market. But let's get some insights out of someone who knows a lot more about this than we do. Tony Rodriguez, head of fixed income strategy at Nuveen, here to kick us off to the close. And I don't know what to make of a market. 10-year yield at 4.2 and change. 30 years, you're getting 4.8, and on the short end, you're getting 3.6. Are those yields attractive to you at all, Tony?
Good afternoon, Romaine. Good to be with you. We would say that yields right now are kind of at the low end of the range that we expected for the year. So we're thinking that we'll end the year on the 10-year around 4.25. So to us, a lot of the value in the fixed income markets has been extracted here at these levels. So we've kind of turned fairly neutral to maybe even expecting a little bit of a backup if we get data that is not supportive of the negative economic narrative. Now, we do think that we're going to see slower growth in the second half than in the first half. So we think yields are justified here, but we just don't think there's a lot of upside to the market in terms of lower yields from here. We think a lot of the news is priced in.
But it's kind of interesting when you look at the positioning. It does seem like a lot of folks are sort of positioning for lower yields, you know, for an additional rally in treasuries. I don't know if that's solely about the Fed. I mean, there are obviously some other dynamics at play there. But when you look at the auction that we had today, and everyone on the 10-year, and everyone, of course, is looking to tomorrow to that 4-week bill auction and just the enormous size size of it, is getting to this idea of what fixed income traders are even willing to buy at current yields. Is it all just short-term debt at this point?
Yeah, at this point, the short-term end of the market is a little more attractive because we are expecting Fed cuts. We think we'll see 2 cuts this year and an additional 2 cuts next year. So you could see the curve steepen from here, in our opinion. So when you look at the front end out to maybe 5 years, there's a little bit of room there for a rally over the next couple of quarters. Whereas when we look at the back end, we think we've seen the majority of the move. The back end's still going to suffer a little bit from higher term premium, given budget deficits that we're expecting to see continue over the coming years. So again, we also think inflation will be stubborn in terms of returning to the Fed's 2% target. So the long end looks like it's kind of extracted all of the value that we see in it. We think at this point, it becomes more of maybe a hedge to the downside scenario, where if we're wrong and we don't get 1% growth but fall into recession, in that scenario, we could see a more significant rally at the back end as well.
Tony, what is the anxiety that this rally is reflecting? I mean, you mentioned a drag on economic growth, you mentioned higher inflation, but that's not a very tantalizing economy if we get either or both of those scenarios.
That's right. So we think that when you look at risk markets, they're probably a little bit too optimistic in terms of not really factoring in enough of the potential downside, even though we're thinking we'll avoid recession and we are going to see slow growth. So we think the markets, equity markets, risk premium, and credit markets have really priced in more of the good news and are failing to maybe take into account some of that negative downside. When you look at the Treasury market, on the other hand, we think that the rally that we've seen, particularly following the employment report, that has begun to price in some of that more negative potential economic data that we might see coming down the road. So there's a little bit of a disconnect between the two markets, which leads us to want to be kind of neutral on duration. I think we've seen the majority of the move here for the year, and also a little bit defensive when we think about credit risk in the market, because we are priced at relatively tight levels.
Yeah, tight now, Tony, but as we can see, those repricings happen very fast when they happen, and then, it sticks around, that sentiment, for some time, at least in the bond market. What is the Fed supposed to do here? You're looking for a base case of 2 cuts this year. You've Goldman with 3. You've Ed Yardeni with none, because he says we're going to see an uptick in inflation as soon as next Tuesday. How does the Fed think about this?
Yeah, I think the Fed right now is tilting towards focusing a little bit more on the employment market and trying to look through some of the inflationary data. So we do think we're going to get stubborn inflation here, particularly as the tariff data starts to come through into the inflation data. So the Fed, I think, is going to look through that and focus more on the unemployment level. So right now we're sitting at just below 4.3%. If we see, our expectations will end the year around 4.5%. If we get to that 4.5 more quickly, say in the next 1 or 2 months, we think that'll trigger the Fed to possibly be more aggressive than our expectations of 2 this year, followed by another 2 next year. But we do think they're going to be more reactive and sensitive to the labor market than they are to the inflation data, which we think they will dismiss a bit as a one-time tariff pass-through that will eventually moderate as we move into the middle of next year.
So it sounds like you're seeing a little bit more potential upside, or at least certainly not the dour scenarios that some people have been pricing in with regards to the economy and markets.
That's correct. We do think we're going to see a slowdown, but we do think we'll avoid the worst case recession. There's still some positives happening. Certainly, when you think about what's going on with AI and AI investment, that is supportive, that business investment. When you think about these budget deficits, which are problematic in the long term and certainly increase the term premium, they will be supportive to the economy as we move through the first half of next year. So we think we'll see kind of the weakest point of growth second half of this year, and a little bit of a return to closer to 2%, still not really strong, but closer to 2% growth next year. So again, it's not a really optimistic outlook in terms of strong growth, but certainly avoiding the worst case outcomes.
All right, Tony Rodriguez, head of fixed income strategy at Nuveen, as we continue to see a steepening of the yield curve, actually seeing an interesting move higher on the longer end of the curve with regards to Treasury yields. On the shorter end of the curve here, not really seeing a whole lot of activity, yields to the downside. Meanwhile, back in the equity space, stocks trying to stretch for a record high, and they're being led higher today by Apple in a big way. That company set to report after the bell tonight. set to appear, after the bell tonight at the White House, a special announcement with regards to additional investment in U.S. manufacturing capacity, Bonnie.
And it's been powering the stock all day, as you said. We'll also be looking at Disney's big streaming wins because they weren't enough to put magic into its results. We'll discuss what's next for the Mouse House and for the entire streaming world with Seaport's David Joyce and AlixPartners Jeff Goldstein.
A lot of earnings after the bell tonight, and we're going to break it all down for you. And we're going to have a conversation with CEOs of two of the companies reporting, including Remitly and Informatica. This is The Close on Bloomberg.
Apple stock headed for its biggest gain since May, with the company set to invest another $100 billion in U.S. manufacturing. CEO Tim Cook is expected to attend President Trump's unveiling of that investment next hour. So let's bring in Sarah Kunst, Managing Director at Cleo Capital. Sarah, 100 million added to the 500 billion, 600 billion sounds like a lot of money, but when you consider that Apple has said that it's going to have to eat $1.1 billion in the next quarter, and it ate $800 billion last quarter, it's kind of chump change, no?
They absolutely found that 100 million in their couch. This is not a huge, meaningful investment, especially when you look at the 500 million they had already committed this year, and the several hundred million in the years prior. So I think that this is about keeping the president happy. We see that is important. He wants announceables. He wants to have those big moments at the White House. Tim is giving him what he wants, and it doesn't cost the company that much at all.
Yeah, I mean, we're waiting on the results of that Section 232 investigation. Is this essentially buying a carve-out? Could it work with this president?
It seems to work very well with this president. And I think that is absolutely what Apple has in mind, right? Is how do they say, okay, we can't move our supply chains here. We're not going to be setting up these massive sprawling supply chains. We don't have the high skilled trained labor that can assemble iPhones at the cost needed to sell them to a consumer. So what do we do to get around that? And the answer is they need these carve outs. And the best way to get these carve outs is to give the president a moment where he feels like he's won. And I think that that's what we're going to see tonight.
Absolutely. And we should point out, I mean, this is kind of a repeat of what we saw during the first term. Remember, Apple and Tim Cook facing down significantly higher taxes, a needle, if you will, that Tim Cook managed to thread back then. But I do wonder, Sarah, if times are a little bit different. It's not just Apple that's having to placate the president, but it's the NVIDIAs, it's the Intels, it's the Oracles, it's a whole host of big tech companies, Metas, if you will. And I do wonder if there is enough political capital amongst all those companies to go around.
I think that it really matters keeping him happy in the moment. These aren't these sort of long strategies to worry about. It's a question of what's going to keep him happy today. How do you keep him on side today? I think that Elon Musk was a bit of a sacrificial lamb in that regard, and that they saw that arc. They know that even 300 million directly to a campaign finance fund isn't always going to be enough. And so I think that they've all learned from that, and they are doing what they think is best. You see a lot of kind of keeping their mouths shut about political issues, about the tariffs. You're not hearing much pushback openly on them. And then behind the scenes, they are figuring out what will move the needle with the president to keep them sort of on side.
Beyond the politics and whatever Tim Cook is doing down there in Washington, this is a company that was facing a lot of big challenges even prior to this administration coming in with iPhone, or let's say a product cycle that was starting to feel a little bit stale in some of the refreshes, and now recent concerns that they're not necessarily keeping pace in the AI race. When you look at Apple as an investment opportunity, Sarah, where does it rank for you right now?
So I think that the AI stuff is a little bit overblown. Apple's just not fundamentally a software company, and I think it's okay if they don't lead. Would I like to see Siri get a little bit better at knowing what I'm talking about? Sure, but I don't think that is do or die. This is a device company. The device refresh cycle, I think, has slowed down, both because there's less newness and innovation, and also because the consumer wallet is not particularly happy right now. And so I think that's okay. And I also also think it's priced in. When you look at their 1 year, they're not doing super well year over year compared to a lot of their peers. They have a reasonable sort of price earnings ratio. This is a well-priced company, I think, for the business that they're in. And I don't get to say that often about tech companies.
For sure. I mean, it's trading right now lower than 34 of the 47 price targets on the street. Read into that what you will. Of course, they could change any day. But I am curious as to whether moving some of its supply chain to India was the right decision, Sarah, in your opinion, given the deterioration in relations between the US and India, at least at the moment.
I mean, who doesn't the U.S. have a deteriorating relationship with right now, right? It is incredibly hard to front run that. I think that more diversity in supply chain is good. I think for both sides of the geopolitical risk, whenever you're talking about two countries, I also think that it's good for environmental risk, right? If there's a monsoon, if there's a wildfire somewhere, you don't want that to disrupt supply chain. So I think that diversifying that supply chain is good. We also know that India is a market that Apple would really love to see more traction in. And so I think it probably did make sense for them to move the business there. The real question over the next couple of years will be how much does that business expand? And I think that's where geopolitical tensions could get in the way.
All right, Sarah, always great stuff. Sarah Kunst, Managing Director at Cleo Capital. And just a reminder for our viewers, we are expecting an event at the White House today, 4:30 p.m. time in Washington, where based on Bloomberg reporting, the President of the United States will be alongside Tim Cook, the CEO of Apple, to announce that additional commitment in dollars for U.S. manufacturing capacity. When we come back here after the break, we're going to take a look at some of the big movers on the day, and that includes Disney. The shares slipping as the company's profit outlook being overshadowing the strength in their streaming and parks unit. A conversation up ahead as part of our top calls. This is The Close on Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations, and we start with CarMax. JP Morgan, which had a sell equivalent rating on the used car dealer for the past 2 years, no more, upgrading today to neutral. The analyst saying sentiment has bottomed and the company's challenges now seem better understood and potentially better addressed. The shares nevertheless down a fraction of a percent on the day. Next up, Axon. Bank of America lifting the taser maker's price target to a street high $1,000 a share, up from $895, with BofA now one of more than 10 firms to raise their price target on the company after a strong quarterly earnings report. Those shares on a 3-day run to a record high. Last up, Snap. Citizens snipping their rating to market perform after 2Q sales results fell short of estimates due to what the company called an advertising glitch. But the analyst also says that Snap faced greater competition, a big part of the reason why some folks are adjusting their outlook for the stock. You see the outlook today down about 18%. And those are some of our top calls. We do want to stay in the realm of media, if you will, and talk a little bit more about Disney. They reported earlier today the shares moving lower after the firm reported strength in its streaming and parks unit in the quarter, but a tepid outlook when it comes to profitability. David Joyce joins us right now. He's Seaport Research Partners senior analyst, and he's got a buy rating on the stock. So what did you make of the earnings? I mean, when I look at the market reaction, the earnings didn't actually seem awful. Even the outlook, while I understand it was slightly below expectations, it also wasn't awful. Why do you think we're seeing such a negative reaction?
I think that that's probably because there wasn't a better top line performance in the quarter that they just posted. It was in line, maybe a little soft at some of the divisions, actually a little soft on the streaming side, but they raised the profitability outlook for the final fiscal quarter. So it was a beat on the margins in the quarter. I think that generally, the guidance was better than expected going forward on the streaming side, and a little bit on the sports side, a little bit on the streaming side, but the experiences side also was probably at the high end of the guidance range they provided before. But they do still have the pressures on the linear network side, but that should really be of less concern.
With regards to a lot of the moves that they're making, particularly when it comes to the ESPN strategy going forward, there's kind of this overhang right now with regards to leadership. The idea that there are now a lot of long-term projects being put in place under a CEO who presumably is short-term.
Well, that's precisely the point, is that those long-term projects are in place. I think that gives the investors visibility into what the company needs to be executing on in adding new lands and into the experiences side of the business, adding more cruise ships. Those are known to be on the horizon. 2 more are being put into service later this year. They announced a new Abu Dhabi theme park that'll be developed really without Disney capital, but that still will help their revenues. So that's in place. You also have some ESPN strategies that are solidifying its position in the sports ecosystem, with NFL taking a 10% stake in ESPN and ESPN getting some additional games and some other NFL media properties. They also announced this morning ESPN's getting some WWE rights starting next year that Comcast had for the premium live events. So that puts more content into the ESPN ecosystem that will help them with their new upcoming launch of the direct-to-consumer access there. Yeah. So that's really the point, is that you need to have these strategies in place. And I think on the film side, too, you have some big titles coming out later this year and into next year.
Yeah, just on that, David, presumably there'll be some kind of an agreement which will allow ESPN to have NFL games and WWE immediately when people start, subscribing when they bring out their new direct-to-consumer just in a couple of weeks. If that happens, will it be accretive to Disney's bottom line immediately, or when will it be? And by how much? I mean, is it significant?
It will be additive. It's not going to be a game changer. The ESPN direct-to-consumer app is really aimed at providing the content that Disney has available to you as the consumer and that you're paying for in whatever platform you want to view it. So it will probably help reduce churn, which is better for margins. That keeps the consumers in the environment. That'll help advertising as well. It can help ratings. So it's not going to be terribly noticeable, but it is additive. And again, I think that you do see that in some of the increased guidance that they did provide today. They earlier said the profitability for the sports business would be about 16% growth. Now they're saying about 18% growth for this year. So there is some short-term and long-term positives that comes from this launch, I believe.
And briefly, David, just curious, Weiger has said he definitely is stepping down at the end of next year. When he does, will sports be as important to Disney as it is now?
It will continue to be as important, as will the experiences, where they're investing $60 billion over 10 years, as will the content engine coming out of the studios, because you need that new intellectual property, the new extensions of Star Wars brands. Or later this year, there's another Avatar coming out. There's a Zootopia, the sequel coming out. You really need all of these engines to be driving. And there are definitely some synergies in between them all. But because you want to have the whole family involved in using Disney products and enjoying Disney content.
All right, David, thank you so much. That stock down about 2.3% as we speak. That is David Joyce, Seaport Research Partners Senior Analyst. Staying with media, we're going to be speaking with Jeff Goldstein of AlixPartners next. This is Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Vonnie Quinn.
Hello, Vonnie.
Hey, Romaine.
How are you?
That's good. I'm as good as the equity market right now. It's pretty good.
Well, that's pretty good because we're almost near record highs. Not doing really good was we were just talking about Disney. That's like one of the laggards on the day. But that conversation kind of brought to the forefront this idea of how much media companies are changing. And that hits close to home, obviously, for us. But it's not just Disney, right? It's Warner Brothers. It's obviously everything going on with NBC and Universal and the potential spinoffs there. Just a huge landscape shift right now going on in the media industry.
Exactly. And you have to think that even with these mergers and these carve-outs and these, demergers and so on, there's more to come, right? Because they're all looking for a way to create value, and they're all trying different, methods of doing this. And some people out there have extraordinary ambition for linear TV still.
Yeah.
I'm looking at you, David Ellison. And some just see, the writing on the wall that it is done.
Yeah.
And it's just going to be fascinating. So with all of this, our next guest says M&A activity is more likely to wait until 2026. That means there's more to come. Joining us now is Jeff Goldstein, partner and America's leader for tech, media and telecommunications at AlixPartners. So Jeff, on that question, are these companies creating value, or do we have to wait for the next round of mergers, demergers, consolidation, etc.?
Thanks for having me, Vonnie. First off, these companies are creating value in the sense that assets are being aggregated in a way that creates some opportunity for building on scale. Companies first, though, are needing to figure out how, as they do these carve-outs, how to protect their core and how to make the operation be a bit more efficient. At that point, they'll be ready to build for scale and create opportunities to aggregate more cable company assets and ride out the pay TV, ride out the rest of pay TV. Streaming is 45% right now of total television viewership, but broadcast and cable are not too far behind it. So there's still value for many, many years, just like there's value for many years in, for example, newspaper subscriptions.
Yeah, I mean, we saw that today with New York Times, right? Adding subscribers to a great degree, but the figures are fascinating. I mean, YouTube TV is really sort of taking over everything right now. Are we moving to a world where we all just subscribe to YouTube TV and that's it?
And Vonnie, it's not just YouTube TV. YouTube Story starts with core YouTube, which is becoming the dominant viewership, the dominant way of viewing on big screens in homes. 12% of what YouTube, or 12% of viewers are viewing YouTube on their big screens, which is more than any other streaming service, even Netflix. And so YouTube, the experience is much more about than just about YouTube TV. It's also about YouTube Core.
I am curious, though, what M&A activity truly looks like. And by that, it's a little bit of a loaded question, but it's one thing to say, okay, we're going to take all these legacy businesses, shuffle them up, recombine them in some way, and we have something new. But then when we talk about YouTube, we talk about, obviously, the advent of the pure play streamers, like the Netflixes of the world here. There's a different business model that's emerging for media. And I wonder if the facilitation of that business model needs M&A.
The business model of pure play streamers has a track record that they believe they don't need M&A. We've seen Netflix do most of their growth organically, very little M&A. We think about Apple TV, that for years has been rumored as a buyer of legacy media assets. They've not gone forward with any of those rumored purchases of legacy media assets. Like you said, they are building a different business, and they're building a business that's based on creating audience and creating engagement. The legacy media companies still have a place where they have audiences, they have sports rights and sports access, and that they will be combining to be able to ride that out and ride the wave.
And I was thinking about it, and it's funny you say that because Netflix has always had a very organic approach.
Yes.
And then you have something like Amazon Prime. They made the big acquisition of MGM, 2 or 3 years ago, obviously to get content. What about on the advertising side? I know there are some of these companies, obviously like a Disney. I mean, they are pretty much have always been an ad company to a certain extent. But for the ones that maybe weren't traditionally in that space, is there an M&A opportunity there, or is that something they can build out their own ad platforms, ad tech themselves?
So first off, Amazon is one of the biggest advertising businesses in the world. They grew it up organically. Netflix opted to grow its business largely organically. They did some partnering initially, but now they've built their own ad tech stack, and they're trying to control their own destiny from an advertising perspective. It's created different focus for their business because they're much more focused not just on subscription revenue and keeping customers coming back, but they're also more focused on engagement because that's what their advertisers demand.
Beyond this wave, do you see ESPN, ABC staying at Disney? What do you see in terms of Warner Brothers and Discovery when they become separate entities? Do they stay separate entities for a long time to come, or does a tech company snap one of them up, etc.? What happens to Paramount Skydance?
Yeah, my perspective, first off, on the tech companies is there have been so many opportunities for them to buy the pay TV or the broadcast companies that they've declined to move forward in doing during times when the cash flow was higher, that I don't expect that they'll be doing that type of M&A. However, financial buyers or potentially combinations of like assets could be the same. But if I think about, you mentioned Paramount Skydance expected to close in the coming days, they've made major commitments around how their business is going to change. They've talked about synergies, they've talked about connecting with creators, and they've talked about how they're going to make it more of a technology company and tech-enabled. All of those things require some execution and some time. So I wouldn't expect Paramount to go out and go shopping right away. Rather, they need to change and transform their business, and then they might be in a position to be a buyer.
How important is scale in that space right now? I know everyone looks at Netflix and with their 300 million subscribers, Disney's at 100 million. Everyone says that's what you need. But there are still a lot of niche players in the media space that are doing pretty well. They may not be publicly traded and get the same attention, but they are viable businesses.
Yeah. The advantage of scale historically was about negotiations with your partners. You had your content distribution partners, your Charters, your DirecTVs, and if you didn't have scale, you were in a difficult place in those negotiations. The way that the landscape has emerged, you still have distribution partners. Many of them are different ones now. They include Roku, they include Amazon. You still need some type of scale for your relationship with your distributors, as well as your relationship with your advertisers. Those are your main revenue channels for media companies. And it's very difficult to expect that we would move forward without those revenue channels being still important.
All right, Jeff. Great stuff, and really illuminating too. And we got to get you back. I mean, everyone's focused on that Paramount Skydance deal, but I'm really looking at personal interest, obviously, in some of these spinoffs and some of the new structures that we're going to see out of some of the other media companies as well. Jeff Goldstein, there, partner and America's leader for tech, media, and telecom over at AlixPartners, as we continue to count you down to the closing bells here on this Wednesday afternoon. The S&P 500 and the Nasdaq right now holding on to some of their gains. And one of the movers in the space today is McDonald's, an interesting earnings report, an encouraging earnings report, if you will. It's our stock of the hour. We discuss it next. This is The Close on Bloomberg. Time now for our stock of the hour, and it's McDonald's, a strong showing after earnings. The stock right now headed for its best day since at least March 7th. The company beating the top and bottom line estimates. Michael Halen is our senior restaurant analyst over at Bloomberg Intelligence. 3.8% sales growth here on a same-store sales basis. That's globally. I am curious. I mean, this is a company that I feel like just a few quarters ago, everyone was kind of just pushing to the side, saying that there was no growth here. What did they do right over the last 3 to 6 months that led to the results that we got today?
Yeah, well, there was two things going on last year. Let's not forget, they weren't the only ones in the quick service space that increased their prices too aggressively, right? So definitely a strike against them there. But E. coli also impacted their results in the back half of the year pretty significantly, right? So this year, they're trying to control what they can control, right? And a big part of that is getting low-income consumers back in the door. That's roughly 30% of transactions, right? And so we started off the year with the new McValue menu, which includes $5 meal deals and buy one, get one for $1, right? And so that's been important. They've been pushing on innovation, right? Chicken's been very important. They've brought back the chicken finger, chicken selects, gave the second quarter a nice boost. Second quarter also had a nice boost from the Minecraft promotion, not only here in the States, but worldwide. And then we have snack wraps coming in the second half. And so, it's been about value. It's been about menu innovation. McDonald's really seems to be hitting a stride again, and comps are easy in the second half of the year because of lapping the E. coli. So, they're set up for a strong second half of the year.
Still though, Michael, how much can McDonald's beat the economy? We're seeing more and more low-income consumers skip breakfast, for example. That was a chilling thing that has been in the reports for the last couple of quarters. And, the Atlanta Fed is saying now that wage growth is really slowing down, 3.7% in June for the lower income consumers, and that's versus, more than 7% a couple of years ago.
Yeah, listen, I skip breakfast every day, so I'm not too concerned.
It's probably not for monetary reasons, though, Michael, honestly.
I'm an intermittent faster. No, but, seriously, yes, low-income consumers, and this is an issue, low-income consumers continue to be pinched. Inflation is cumulative, so these consumers continue to get squeezed as their incomes continue to decline. You have a very good point. In terms of the economy, I think people that are running around with their hair on fire right now are a day late and a dollar short. Restaurants are the canary in the coal mine. Consumers stop spending at restaurants before they stop spending everywhere else, and restaurants had the recession last year. We think, we came into the year saying this year is going to be better than last year. The first half was better than last year. Now we're saying that the second half is going to be better than the first half. We think, the tax cuts that were passed, the economic indicators that we look are improving.
Yeah.
Right. So we don't see a recession at all.
Yeah, and we should point out, too, even if we do head towards not a recession, but just maybe some sort of economic doldrums, the idea that McDonald's does seem to be making a much more stronger move to compete on price. And, something you said just a few minutes ago really resonated, because I kind of forgot how, we saw on social media everyone would post their receipts from McDonald's and show that they were, paying, $15, $20 for, a burger, fries, and, and a drink that would have been, less than $10 just a couple of years ago. And it gets to this idea that I understand that they can lower the prices or offer promotions. How are they doing on cost, though? Do they have enough space on the cost side so that if they are competing on price, it's not going to crimp their margins too much?
Yeah, so the good thing about McDonald's is they're 98% franchise. So their margins are largely insulated from inflation. But, their franchisees, they want them to continue to be profitable and open more stores. So, yes, beef is an issue this year. Beef prices remain stubbornly high, and we expect tech to squeeze franchisee margins, not corporate margins.
Yes.
So, and also McDonald's is the 800-pound gorilla, right? They have so many stores, 40,000+ across across the globe, more than 14,000 in the U.S. They have scale.
Michael Halen, thank you so much. Senior restaurant analyst at Bloomberg Intelligence. This is Bloomberg.
Welcome back to The Close. We keep an eye on Wall Street, but apparently we're keeping an eye right now on the White House, because it appears everyone on Wall Street and everyone in corporate America is spending a lot of time there. We're awaiting a press conference later this afternoon with Tim Cook, the CEO of Apple, and there are conflicting reports coming from other news outlets that the CEOs of NVIDIA, Bank of America, and Citigroup all also, for one reason or another, down at the White House. Joe Mathieu is the co-host of Bloomberg's Balance of Power. Joe, what do we know?
Could be quite a show if they just turn the cameras on the Oval Office, it sounds like right now, Romaine. But yes, if you consider some of the announcements that we've seen and some of the bold faces that we've seen in the Oval Office, it's not always easy to tell what they're doing there at any given moment. But indeed, reports that Jane Fraser is in the Oval, Brian Moynihan, both could be talking about the issue of debanking that President Trump has really been beating the drum on recently. He talked about it during the campaign, called out Bank of America specifically, and did so in an interview earlier this week as well, mentioning J.P. Morgan, suggesting that he couldn't get banking services after he left office in 2021. That could well be something they're discussing, as well as crypto, knowing that many in the crypto sphere said they were debanked essentially because of their association with the technology, and in some cases with MAGA. Jensen Huang at NVIDIA, a whole different thing. And, we've been referring to him as the president's best friend recently, having seen export controls turned lower in talks with China, and knowing that we're coming up on a deadline with China, they could be discussing a lot of particular issues when it comes to export controls on AI chips and what that might mean for our relationship with Beijing. Then there's the matter of Tim Cook, Romaine. The Apple CEO is in town for a major announcement that's set to take place a little bit less than an hour from now. A $100 billion investment here in the U.S. in domestic manufacturing. We knew that Tim Cook would be with the president. We didn't expect all of these other names, though, and I'm deeply curious to see if any of the others join the president when he steps in front of cameras a bit later on this afternoon.
Yes, we should have some answers within the next hour, as he said. Joe, that is Bloomberg's Joe Mathieu, and of course, Joe will be carrying that into Balance of Power at 5 p.m. Eastern after we finish as well. So let's take a look at where we are markets-wise now. We're holding on to those steady gains today. Basically, 400 out of 500 of the S&P 500 companies have reported, but we are still waiting for plenty of earnings after the close today. And we are seeing a rebound for the Nasdaq 100 after yesterday's decline. Also, the S&P up 0.75%. Those yields, though, going nowhere. They went down after that huge rally, and they are staying down. The 10-year yield 422.18, and the dollar index continues to be weak, Romaine.
Absolutely. Emily Roland joins us right now, co-chief investment strategist at Manulife, John Hancock Investments. And Emily, it gets to this idea of not so much how much further can this market go, but what sort of justifies a continued appreciation in this rally?
Romaine, it's really been about momentum and about sentiment. There's been this almost ferocious dip buying that's gone on. You looked at the markets on Friday in response to that weaker payrolls report, and we came into the week with just more bullish sentiment. When we get some better, more constructive news around tariffs, that certainly helps. political developments are playing a huge role in markets. But, we've seen some positives for sure. Earnings growth for the S&P 500, of course, coming in around 10%. The bar was very low. Coming into the quarter, given tariff announcements, the big sort of roller coaster we've seen, and investor and consumer sentiment going from deeply negative to positive, concerns about supply chain. So that bar was lowered. It was almost as if analysts said, hey, we set you up for a really tough quarter and you overcame it. So that's definitely been a positive development. Fundamentals, I would say, are okay, but sentiment here has really been a key driver of markets.
With regards to volatility, I mean, where do you see that going over the next few months? Is that something that markets investors should be on guard for an increase or any potential spikes involved?
Yeah, I mean, they certainly should heading into the fall. We're heading into a weaker stretch seasonally for markets. And really the only thing that's not being priced into markets right now is any risk at all. We're sitting at 22 times forward earnings. The highest we've ever gotten is 24 times. That was back in 1999. So there is a chance that we could see a little bit more multiple expansion here, but it's very limited. High yield bond spreads right around 300 basis points. Tightest we've ever been is about 230 back in 2007. So markets are telling you that everything is perfect right now. And I think that's really the biggest risk that we're facing. Again, we're not seeing anything on the earnings front that's overly sinister. We're not seeing anything in terms of the health of corporations right now that's very nefarious. It's just really that lack of risk in markets that could cause some volatility to peak in going into the fall.
And interestingly, Emily, those Paolo Schiavone comments from Goldman Sachs did cause a ripple across the street today. The idea that this market is very myopic, that it's not looking far ahead enough potentially. I mean, did it give people pause? And if so, why are we seeing continued buying?
Well, we're seeing that, Bonnie. It's a great point across a lot of news that we've gotten as of late. Many strategists out there warning that we could be in for a tougher stretch here ahead. I just think that there's so much optimism baked in. And it's not only in the United States. It is amazing to watch what's happening. The euro is up 11% year to date. European stocks up 20% plus. European financials have become the safe haven trade. They're up 43% this year. Absolutely remarkable flows into non-US equities. A lot of this is being driven by feelings and sentiment and political headlines that are taking capital away from the United States and putting it overseas. I would be very cautious in terms of using Europe as an area to find protection, given it is a lot more cyclical. And again, the argument that Europe is cheap is really no longer there at this point. So we would look to the opportunity to take some gains in those riskier parts of the market and redeploy them into higher quality assets here in the United States.
Yeah, I mean, should we be taking more notice of this bond market rally than we should be of the equity market rally?
Well, we think it makes a lot of sense, and that bonds are starting to work as diversifiers in portfolios here. We talk about this sort of massive amount of momentum and sentiment in markets and the potential for there to be bubbles that are building here. The one part of the market that's not in a bubble is bonds. You look at the 10-year treasury at 422. We think that income that's available right now at high quality bonds is actually quite attractive, given that the bond market is just not sniffing out the disinflation that we see coming down the pipeline. There's such a myopic focus right now on the potential for tariffs to be inflationary, concerns around the deficit that are maybe coming from the one big beautiful bill. But the fact of the matter is that shelter or housing inflation, which is almost a third of CPI, is actually decelerating, and it's decelerating meaningfully.
All right, Emily, we have to leave it there. Emily Roland, co-chief investment strategist at Manulife, John Hancock Investments, helping us count you down to the closing bells. Those bells now just about 2.5 minutes away, with an equal sort of dispersion right now in the S&P 500, Bonnie, with half the stocks in the green and half in the red.
Yeah, and absolutely, if you look at Bitcoin, it's also rallying today as well. And I think that's another sign of this appetite for risk.
S&P up 0.7% on the day, with a focus on equities. Apple, Amazon, Broadcom, Tesla leading the charge. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romain Bostic alongside Bonnie Quinn taking you through to that closing bell with a global simulcast. It starts right now. Carol Masser in the radio booth. Matt Miller in for Tim Stenovic once again here as he pulls off his glasses. And we welcome our audience.
What is he like?
All of our Bloomberg
Superman?
platforms. He is Clark Kent with just, less hair and without the cape. We love Matt Miller.
That makes you
Matt
Lois
Miller,
Lane, though, right?
63.44 on the S&P 500, up 0.7%, trying to stretch back, Carol, to that record high.
Yeah, exactly. Some enthusiasm, but you dig a little bit deeper and you realize, there's about half of the S&P trending higher, half of it lower. So once again, you got to look a little bit deeper. But yeah, overall, we're up. Thank you very much, Apple.
Yeah, we're still sitting right there at 420 on the 10-year. So this continues to be interesting to me that we've seen no movement in treasuries since the big jumps that we saw in price and drops that we saw in yield on Friday. So even as you see volatility in the equity markets, you don't see it in fixed income.
And it's likely that the Section 232 investigations and their outcomes are going to be maybe the next catalyst for these types of stocks.
Yeah, and it's just to your point, though, Matt, too, it kind of feels like a bit of a tug of war, though, too. You have so many people that are trying to make a bet directionally on where yields are going, and no one really seems to know. And obviously, no one's going to know, at least until the Fed or maybe some kind of harder signal comes out of Washington.
Yeah, off to Jackson Hole, too, in September, and we'll see what happens.
Are you going to Jackson Hole, Carol Masser?
I wasn't invited. What's up with that?
Me either. Apparently, Mike McHugh.
It's like literally everybody else at Bloomberg is going.
I know.
Thanks, Matt.
All right, let's walk you through the markets here. We have another day of earnings, including more than 24 companies of note scheduled to report after the bell, including Airbnb and a few others, on a day where we see the S&P rebound up 0.7% on the day, higher by about 46 points at that 63.45 level. The Dow Jones Industrial Average higher by more than 80 points, or 0.2%. The Nasdaq Composite and Nasdaq 100, those are your outperformers on the day, each up by about 1.2 to 1.3%. Transport's also higher on the day, but we did see a significant lag in the small and mid-cap space. Mid-caps down about 0.3%, and the Russell 2000 down 0.2.
Yeah, that's certainly interesting. I'm going to go back to the S&P 500, as I like to do. 240 names in the index. Vani gaining ground today, 263 to the downside.
Yeah, and if we look into the map of the S&P 500, you can see that we are basically green. As you said, Carol, we have got, more than half higher and some lower, but consumer discretionary is the name of the game today, up 2.5%. It does feel like when, certain companies step out, other companies step in to take over the mantle. Like obviously today it's Apple, for example.
All right, you mentioned Apple, so let's go there because that is our number one gainer, for me at least, on this Wednesday. Up about 5% here in the aftermarket. We are expecting around 4:30 p.m. Wall Street time the president to make some announcement about another $100 billion investment on domestic manufacturing by Apple. Devil's in the details. We know Apple already spending about $500 billion investing in the U.S. over the next 4 years, but we'll see what we'll get. But Apple up 5% here in today's session. Arista Networks, ANET is the ticker, up 17% here at the close. Number one gainer in the S&P 500, reporting after the close yesterday, surging to an all-time high. This company's revenue forecast for the third quarter exceeding the average analyst estimate. A bunch of analysts raising their price targets on the stock. Bloomberg Intelligence Woo Jin Ho writing today that the company's reinforces its AI networking confidence. So some real outperformance there. And Shopify up about 22% here at the close. I believe it's the top gainer in the Nasdaq 100. The company becoming the most valuable in Canada. Citigroup called the earnings results a blowout, but I know we've got some earnings right now, Romain. What do we got?
Let's get to Lyft. The share is spiking by about 7% in the after-hours trade. The company said that in the second quarter, revenue actually came in a little bit light, $1.6 billion. The street was looking for 1.61. And on the EPS side, also a miss there. EPS at 10 cents a share. The street was looking for 27 cents. But here is their guidance going forward. The company says that for the current quarter, the third quarter, it sees gross bookings of 4.65 to $4.8 billion, and says that EBITDA should come in a range of $125 million to $145 million. I need some time to check the comparisons with analyst estimates, but you see the knee-jerk reaction in the shares right now is to the upside.
Yeah, expectations were not so high for Lyft today, particularly after Uber this morning, and I guess it's beaten those expectations.
Oh.
What's better? Let's go to
$6 billion buyback.
Let's go to Airbnb.
Not Lyft, by the way.
No.
Lyft has not approved a $6 billion buyback.
Let's go to Airbnb, and you're seeing, as Matt mentioned, yep, that's the big headline, authorizing a new $6 billion share buyback program. That stock, though, right now initially down about 2% here in the aftermarket. Let's go to the forecast for the company. It still sees about a fiscal year adjusted EBITDA margin of at least 34.5%. We'll look for some comparison. As for the second quarter revenue, $3.10 billion, a little bit better than what the street was expecting, $3.03 billion. And then second quarter adjusted EBITDA of $1.04 billion. The estimate was below that at $970.7 million. And third quarter revenue, $4 billion, sees for third quarter revenue. So again, the outlook sees third quarter revenue, Matt, $4.02 billion to $4.10 billion. The street estimate is $4.05. But again, a new $6 billion share buyback stacks up. Now it's unchanged. So investors kind of bouncing around here in the aftermarket with.
Yeah, I mean it's only an
2%.
It's only an $82 billion company. So that is an absolutely massive buyback for this company. That kind of just begs the question, do they have nothing else to do with the money, or they just have so much cash that they need to return some to shareholders? The stock has been flat on the year.
Yeah, and it's a good point, too, particularly at a time where we see so many companies taking that cash and reinvesting it back into the company, that big boost in CapEx spending amongst a lot of the tech companies. But I do just want to point out, this is a company that was also making a big bet on experiences, the idea that they want you to do more than just book a room. They actually want you to hang out, go backstage at concerts. They had a big partnership recently with Lollapalooza. And I was trying to look for a breakout of whether they had actually disclosed what they make specifically off that business. It's not really clear that they do that, but you did see an interesting bump up in gross bookings of about 11% to that $23.5 billion level, which was significantly higher than street estimates.
And today really is the day for gig economy companies. We're going to be waiting on DoorDash as well, and others. But if you look at Lyft shares, they have absolutely reversed now and are down more than 9%. So while, at first glance, some of these metrics beat, there was definitely some negative news in the Lyft earnings. It's not really reflecting well when it comes to, Uber and its Waymo partnership and so on Lyft.
Speaking of DoorDash, they're out with their earnings, a beat on the bottom line. EPS coming in at 65 cents a share. The street was looking for 45 cents a share. Revenue also beating $3.28 billion. The street was looking for 3.17. And here is your forecast, the guidance for the third quarter. The company sees marketplace gross value of $24.2 to $24.7 billion. That is above the average estimates of what the street was looking for. And it also sees adjusted EBITDA for the current quarter of $680 to $780. It's a pretty wide range, but we should point out that the average of analyst estimates is in the middle of that range at about $720. So a beat pretty much on both the top and bottom line for the quarter, and the guidance going forward also above street estimates.
All right, we just had a small cap, mid cap investor who likes Elf Beauty, and they are reporting their earnings, and we're seeing that stock. We'll bring it up in just a moment. Adjusted EPS, 89 cents a share, folks. That was about 6 cents better than what the street was expecting. Net sales, $353.7 million. That's pretty much in line with what the street was expecting. The estimate was $353.5 million. And then adjusted EBITDA, $87.1 million. That is above what the street was looking for, $74.3 million. We are seeing the stock, though, down about 1.4% here in the aftermarket.
All right, I've got Zillow here. So far, just out with revenue in the second quarter. Rentals revenue was in line with estimates at 159 million even, I should say, compared to an estimate of 159.7 million. Mortgages revenue was higher at 48 million compared to 44.5 million. That's interesting. And residential revenue was higher at 434 million compared to an estimate of 429 million. The chief executive officer, Jeremy Waxman, says the results reflect how the power of their strategy and the strength of their execution are fueling growth across the company. But will be interesting to see if they earn money.
Just a brief word on TKO, because we saw that $1.6 billion deal from ESPN and Disney, obviously, for the WWE rights. It beat as well on the bottom line and on the top line. The UFC revenue was a tiny bit light, but everything else, including WWE, beat.
Let's check in on Bumble, the dating app coming out with their earnings right now. It looks like a beat on the top and bottom line, with EBITDA coming in at right around $95 million and paying users now at about 3.78 million, though we should point out that does appear to be a miss. The street on average was looking for paid users of 3.96 million, but revenue did come in above estimates at 248 million, higher than street estimates of 244, and the company also saying that it has found a new CFO. His name, Kevin Cook, the interim CFO, is going to step down from that role, as now we get a clearer picture of what the management looks like for Bumble going forward. A modest increase in the shares in the after-hours trade.
Yeah, Bumble up about 6%. Just a real quick line. I want to go back to Elle for a moment. The company is not providing a full-year fiscal 2026 financial outlook, and it cites potential outcomes related to tariffs. So we're starting to slowly get the impact when it comes to tariffs. Now I'm going to go to Duolingo because, man, this stock initially just soaring in the aftermarket. Let's get to it. And in terms of the outlook, third quarter adjusted EBITDA, it sees 69.4 million to 73.1 million. And the estimate on the street, that was 70.5 million. Sees fiscal year revenue 1.01 billion to 1.02. It had seen 987 million to 996 million. So it's upping up that number. Also sees third quarter bookings of 268.5 million to 272.5 million. That too seems like it is raising its expectations above what the street's expecting. Go back to the second quarter, EPS for the second quarter, 91 cents, easily beating the street estimate of 68 cents a share. And second quarter revenue, that too was a beat, 252.3 million versus the $240.6 million estimate. The stock is up, folks, 24% here in the aftermarket.
Yeah, absolutely. One of the biggest movers in the aftermarket. Another big mover is a company called Remitly. This is a wire transfer company that's primarily based online. The street was coming into this quarter expecting the company to post a loss. It actually posted net income of 6.5 million in the most recent quarter, revenue of about 412 million. That was also a beat. And for the full year, the company says look for 1.61 to 1.62 billion dollars in total revenue, higher than its previous guidance, which was around 1.57 billion dollars. Similar story when it comes to EBITDA, raising its guidance there as well. And I should point out, we're going to have the CEO of Remitly on the program a little bit later this hour.
Exactly. And we're also going to be having the CEO of Informatica, which also just reported. Now, revenue was definitely a beat, $407.3 million. Adjusted EPS, though, a slight bit light, 18 cents versus the 20-cent estimate. We'll ask the CEO why.
I got Fortinet, which is really a $75 billion internet security company, coming out with billings that were much higher than had been anticipated. The street was looking for 7.2 to 7.4 billion for the full year. Fortinet says there'll be 7.33 to almost $7.5 billion, and as a result, those shares jumped. They beat on second quarter EPS at 64 cents versus 59 cents. They have a higher adjusted EPS expectation than the street. They're saying, well, 62 cents to 64, and the street was only looking for 62, and a range looks the same in terms of revenue for the third quarter and full year, at least as good as or better than the street was looking for.
All right, just a few earnings after the closing bell. On to Apple. We'll wait for the president's news on that, expected around 4:30 p.m. Wall Street time. That is a wrap. Radio, TV, YouTube, Bloomberg Originals. Vonnie and Romain continuing there, of course. On television, Matt and I continuing on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television with an eye on the White House and that appearance by Tim Cook of Apple, and an eye on earnings. We're going to break down the results that we just got, including from Airbnb. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I am Vonnie Quinn.
And I'm Romain Bostic. The S&P 500 trying to recoup some of the doldrums that it had the last couple of sessions, up about 0.7% here on the day. A big lift coming from Apple here on this Wednesday afternoon. In fact, 6 of the Mag 7 stocks moving higher on the day, taking that index as a whole up 2% on the day to a fresh record high. You also saw some strength in the transport space, largely because of some good big gains that we saw in the travel space, Vonnie, particularly when it comes to the airlines like Delta.
Well, staying in the travel space, let's look at some notable movers in after-hours trading, because we did, of course, start with the gig economy companies this morning with Uber. We got Lyft after hours. It did post profit in the second quarter that exceeded Wall Street expectations. Its effort to expand globally, obviously gaining some ground, but there was some disappointment there for investors, and that stock initially popping down more than 7% now in the after-hours trading. Then DoorDash, another gig economy. Those shares up more than 8% at one point right after the revenue topped estimates in the quarter, and those figures came out. Orders coming in at 761 million. Somebody obviously still ordering DoorDash even with the costs that we're seeing. And, you know, its marketplace is growing as well. It also beat on the bottom line. And then another one that's getting punished in the after hours is Zillow, even though it did beat earnings estimates. Sluggish housing market, of course. We might have been able to anticipate some of that. It did definitely see rental operations jumping 36% year over year, though, which was one bright spot in that earnings report.
All right, I like the theme there on the gig economy. Let's keep an eye on Airbnb. The share is fractionally higher after that company just reported earnings. It looks like a beat on several key metrics, but really the big headline here has to do with the guidance that it's giving going forward, and of course the idea of some sort of return of cash to shareholders, a $6 billion share buyback program. Tom White joins us right now, senior equity analyst over at D.A. Davidson. When you take a look at Airbnb, you take a look at the growth. Tom, are you pleased with what we learned today?
Yeah, look, looks like a pretty good quarter from what we can tell. There's a little bit of upside on room nights and gross bookings. The guidance for room nights in the third quarter reflects basically stable year-over-year growth rate versus what we saw in the second quarter. And so, I think it sort of echoes kind of what we've heard from some of the other online travel brands, at least so far this earnings season, that the broader underlying kind of consumer demand for leisure travel continues to be strong. That doesn't mean that all geographic markets are equal. Geographic mix really matters here. The U.S. Is actually one of the relatively slower growth markets right now, and one of the softer markets, just given some elevated concerns around tariffs. But we just think Airbnb is doing the right things around affordability and new products too that are going to help this remain a resilient and profitable grower here.
And of course, the weaker dollar helps Airbnb to some extent as well, right, Tom? Romain mentioned experiences earlier. Will we find out more on the call? Obviously, it's not broken out as much as we'd like it to be.
Yeah, we'll see. I wouldn't hold your breath. They've had an experience business for a while. They've been sort of reluctant to share how much of that is in the room night number. So I'm not sure that we'll actually get much of an update yet. Keep in mind, they've just recently relaunched experiences and really just launched for the first time their new services offering. So we'll see. We still think it could be a large multi-billion-dollar and profitable business for Airbnb. I would note Booking.com the last couple of quarters has started disclosing some of their metrics around ticket growth for their attractions business, sort of a similar to experiences for Airbnb. And that grew over 100% last quarter. So it can be a high growth business, but not sure how much color we're going to get just yet.
I am curious. I mean, we talk about Airbnb. Obviously, we're talking about the shortest of short-term rentals in theory. We also had some earnings today out of Zillow, presumably for home buyers, but also a company that is also sort of traffic in the idea of rentals, more long-term rentals, if you will. The shares are reacting negatively. We don't need to go through all the numbers, but it looks like they beat on a couple metrics and missed on a couple others. But I do wonder about your take on Zillow and really the business model of those types of online real estate firms, and whether we need to see them do something maybe a little bit different.
Yeah, look, well, I think their legacy kind of for sale residential home business, it's facing, as we know, a very tough kind of broader housing macro backdrop, and it's going to be hard, I think, for that business to show material outperformance kind of in this environment. That said, it is doing some different things, and it's kind of taking advantage of this downturn in the housing market, or the slowdown in the housing market, to put in place some interesting new adjacent businesses like rentals, like their mortgage offering, that I think are going to put them in a good position once the market picks up. You touched on rentals. It's just a terrific business for Zillow, very asset light, They're guiding to 40% growth year over year in calendar 2025, and rentals already very profitable. No reason they shouldn't be one of the leaders, if not the leader, in kind of rental leads and rentals advertising. So, we still like Zillow here for the long term, but acknowledge, this housing market's going to create some kind of modest headwinds here in the near term.
And then, Tom, I just want to mention DoorDash. You talked about the consumer earlier when we were talking about Airbnb. What can we tell about the resilience of this consumer, given that DoorDash beat estimates as well?
Yeah, I mean, it's been a really amazing story, DoorDash. The stock, obviously, performance speaks for itself. It's up over 50% year to date. These guys just continue to execute very, very well. It's a combination of their really strong execution and just razor focused on extracting kind of the best unit economics they can in that core product. Also delivering on some of the newer businesses like advertising and grocery and retail. But I think it also just reflects the power of the convenience economy. And, once consumers get accustomed to being able to have food delivered to their doorstep very quickly within minutes, it's hard for them to stop using the service, frankly. So, we've been neutral rated on that, kicking ourselves, really just valuation based at this point, though.
Don't kick yourselves, please. We want you to come back without any bruising. That's Tom White, Senior Equity Analyst at D.A. Davidson, and thank you.
All right, we just want to get to some other earnings. This out of DraftKings. The share is moving higher in the after-hours trade. Modest speed on EPS in the most recent quarter, 38 cents a share on the bottom line, $1.51 billion on the top line revenue number. That's also a beat in the guidance going forward for the full year. This is what the company says it expects for revenue, $6.2 to $6.4 billion. The Street was looking for $6.3 billion. And on the EBITDA side, it's guiding $800 to $900 million. The Street on average looking for about $828 million there. We should also point out the company says that it is going to stand by previous guidance and says that it includes the estimated impacts from higher tariffs. So basically factoring that in, the share is higher by about 6% here in the after hours trade. We do want to turn to another stock, a small cap stock in the payment space, Remitly. The share is up about 10% after the company reported a 34% jump in revenue in the most recent quarter, and it provided guidance, at least on the top line, that does appear to be well above what the Street was looking for. I'm pleased to say that the co-founder and CEO of Remitly joins us right now, Matt Oppenheimer. Matt, great to have you here on the program. I was looking through the numbers and I really honed in on one thing here, and that was active customers. 24% jump, 24% jump, which is just as impressive, quite frankly, to 8.5 million. Where did those people come from? What drove that increase?
Yeah, thanks, Roman. Great to be here. We're incredibly excited about Q2 and our results. It was really a defining quarter for Remitly. If you think about the 8.5 million customers that we served just last quarter and how fast that's growing, first off, we serve customers across 170 countries now. And it's growing because we deliver an affordable, fast, convenient, international person-to-person payment solution. And as we do that, because our business is based on trust, the word of mouth effects of folks telling their family, friends, and loved ones that Remitly is a great service continues to fuel our growth and our business, and we're incredibly excited about what's to come.
On that same note, send volumes was up about 40% in the most recent quarter. Matt, are you taking business from other from some of your peers, or are these basically new entrants into the market, if you will?
Yeah, it's largely folks who, maybe were using a bank or using a cash-based remittance provider, and they realize that sending money via our app, where we can send to 4 billion bank accounts and mobile wallets, for over 400,000 cash pickup locations across 170 countries, more affordably, more conveniently, and 93% of our transactions are delivered in less than an hour. That's 24 hours a day, 7 days a week. That kind of service really wows customers because, as we all know, international payments has been slow, old, and antiquated. And so the way that we're improving it has really improved the lives of our customers.
Yeah, the second quarter net income, $6.5 million, estimated loss, 72 cents a share. Matt, I'm wondering, when do you see yourself being profitable on a per share basis?
Yeah, well, what we're incredibly excited, as Romain mentioned, is we delivered not only 34% year-on-year growth, but also $64 million in adjusted EBITDA, and we were GAAP profitable. So that's not only ahead of the rule of 40, that is the rule of 50 when you combine that top and bottom line performance. But as I look forward, one of the things that I'm incredibly excited about that we're announcing today is that we're broadening our service. So if you look at our vision, it's to transform lives with trusted, financial services that transcend borders. And that is broadening the relationship to be a broad financial partner for our customers. So we've talked about Remitly Business, which is expanding our P2P service, our person-to-person service to businesses. And then we're also adding additional services to our customers. Remitly One is a membership offering that we're going to be offering that includes things like Remitly Flex, which is a send now, pay later solution, and Remitly Wallet, which is the ability to hold both fiat and stable coins. So incredibly excited about what's to come on the product.
All right, so at some point in the next few quarters, hopefully. Matt, I'm curious as to how the Genius Act impacts you and whether you'll have more competitors now as a result.
Yeah, I'd say that the Genius Act has been very positive in the sense that it's cleared up the regulatory framework for stablecoins. And so as we think about our Remitly Wallet offering and being able to offer stablecoins like USDC, that's great because that regulatory clarity enables us to offer those services more conveniently and more clearly.
Matt, well, speaking of Washington, I mean, there's been a lot of policy changes, or at least the potential for policy changes that have had a variety of effects on the financial services industry. I am curious. Just a couple of weeks ago, we were talking with Western Union when they reported, and they kind of brought up this issue that part of their business had been hurt by some of the issues having to do with immigration, the immigration roundup, and the idea that a lot of the folks that were in this country, whether it was legally or not legally, the idea is that they were earning a living and sending a lot of money back, which of course benefits transfer companies like yourselves. Have you seen any impact from the immigration crackdown on your business?
Yeah, great question, Romain. Thanks. I think that when you look at our specific customer base, because customers have to link their bank account or debit card, and then they have to provide information so we can do what's called Know Your Customer, that tends to be a more established customer that we serve. And so because of that, we have not seen an impact in our business, and that's you can see in the results of our overall revenue growth and customer growth, and we're really proud and excited about that.
All right, Matt, really appreciate you joining us, particularly just as your earnings come out. We'll let you get back to it. I know you're busy. Matt Oppenheimer is the co-founder and the CEO of Remitly. Those shares higher here in the after-hours trade. Meanwhile, we want to bring you some breaking news. This involving that report that we had earlier, Vani, about Jane Fraser, the CEO of Citigroup, and Brian Moynihan, the CEO of Bank of America, at the White House are now confirming that they did meet with President Trump earlier today to talk about Fannie Mae and Freddie Mac. There's been a lot of discussion here about what the Trump administration wants to do with these two mortgage finance companies, government-controlled companies that have been in government conservatorship for well over a decade since the financial crisis.
And of course, it would take Congress to actually decide upon this. So there's been, a lot of movement in those stocks, particularly Fannie Mae, for example. But we're seeing here that Fraser was actually pitching public stock offerings. So she went to the president to pitch public stock offerings. So we'll have to see how it, plays out. We've heard a lot, and we know that the impetus from the administration itself is to get these out of conservatorship, as you said. Absolutely
here. And of course, they're going to need the help of some of those big banks to do that, if that is indeed what they intend to do. We're going to get you some more details on that and bring it to you as soon as we get them. Also, just a reminder here, we are still awaiting a press conference at the White House later today with Tim Cook, the CEO of Apple, presumably to talk about additional investments in U.S. manufacturing. When we come back after the break, we get back to earnings with a discussion with the CEO of Informatica. They just reported, and the CEO joins us next. This is The Close on Bloomberg.
Informatica out with earnings this hour. Total revenue beat $407.3 million versus the estimate for $401.7. Second quarter adjusted earnings per share 18 cents. That's slightly shy of the 20-cent estimate. And I'm pleased to say that we can talk to the CEO about this, and also Salesforce agreeing to acquire the software company in May after more than a year of pursuit. That particular deal expected to close in 2027. Amit, the CEO of Informatica, joins us live now. So Amit, just a brief word on why, the bottom line happened to miss, even though top line did beat?
Well, thanks for hosting me. Pleasure to be here. I mean, look, it's a rounding error, as you just said, to be honest. As a company, we are maniacally focused on what is we call our cloud ARR. And that, by the way, beat handsomely. And the cloud ARR was crossed 900 million for the first time, grew 28%. And that's what we're pretty excited about. Overall, we still beat top line, and I think it's a very, very rounding error, as you said, on the bottom line, which is marginal in the course of the large full year in front of us.
You obviously have a pending transaction, and I'm interested, what are your priorities before all of that, closes and is done, a done deal?
taking care of our customers. I mean, the most important priority for us is making sure our innovation engine remains humming, and we had a great Q2, lots to share over there, and lots coming over the course of this year. We have a big release coming in fall, lots of partnership announcements, and of course, making sure our customers are successful. It was evidenced in our cloud net retention rate of 120% in Q2, and we remain focused on that one.
I do have to ask you, Amit, though, about the potential integration when it comes to the Salesforce deal. I know we're still a long way away from that happening. But when you consider some of the concerns that were first raised the first time around when you two had sort of sought to combine, have those issues been resolved? And is there any potential that we could see any, speed bumps, if you will, in the completion of this merger?
If you step back, it's all, as you think about in the context of the world of AI in front of us. We do data management, which is the most critical part of where AI will be successful. You've seen the infrastructure stack play out, but for the models and for Gen AI and the application stack to be successful, you have to bring good data, quality data, governed data, and make sure it can be used by end customers as they run the application stack. We do that for a living, and we are the number one in terms of that. We lead in every Magic Quadrant. And when you think about pairing up with Salesforce in the context of obviously not only playing in this part of the stack, but helping Agentforce becoming successful, that becomes a recipe for huge value creation for our joint customers. And that's the principle of this opportunity.
Do you worry at all about any potential customer attrition in this process, given how long it's going to take for this deal to actually be completed?
Well, I want to correct, actually. It was FY27, and Salesforce runs a fiscal year 1 month off. So it's going to be more beginning of 2026, that said, in a calendar year perspective. When it was set 27, it was more FY27 because their fiscal year is a year ahead. So the stated goal for the closure is more around beginning of 2026, which is not too far. Okay. And our customers still remain very excited, as evidenced by our results in Q2.
When it comes to AI and this, excitement that we're seeing in the markets, and it just continues and continues and continues, no matter what happens in Washington, D.C., no matter what happens at the Federal Reserve, what does it mean for your business, Amit, before you even get integrated into Salesforce?
A great question. If you really step back, as I was talking about that, look, for AI to be truly successful, it's all about data. I mean, we talk about Informatica is where data and AI come to life. We have our AI called Cleo. And the whole power of that is to make sure we can bring data from any possible source. The more holistic the data, the better is the AI model. Second is to prevent hallucinations, we got to make sure it's good quality data. That's what we do with data quality. And then when on the other side, you want to basically give it in the hands of humans or run it by itself, you want good governance on top of it. That's what we do, data governance. All of our stack is basically growing because of Gen AI. And in fact, last quarter, we really were on a tear. We've launched our Clear GPT and Copilot are already out. We got the agents coming out later this fall. We announced more partnerships with Databricks, Snowflake, Oracle, NVIDIA in particular, along with expanded partner with Salesforce. We are firing on all cylinders to also expand the ecosystem because ultimately it's going to be all about managing the data for AI to be successful.
Amit, how confident are you, I suppose is my point, that you can, hold up the pricing model that you have and continue to charge customers what you have been charging them?
Well, look at it like our consumption pricing is evidence in the context of how our platform is used. And our IDMC platform, the usage of that grew 30% year over year to 128 trillion transactions a month, which means more and more customers are using more of our offerings. And that's what basically allows us to be more and more confident that our pricing model not only stays because we create value. It's evidenced by these numbers that I just shared.
Hey, so Amit, I am curious just to get your thoughts more broadly. This is less about Informatica specifically, but more broadly, just about the health of that software ecosystem and the demand that's going on out there, and whether that demand is a little bit more lopsided, given, of course, all the attention on AI and all the chase for AI. Is the demand in aggregate healthy? And more importantly, is it broad-based?
Yeah, I think great question. Look, what is happening is that there is phasing in demand. A lot of work is going on at the infrastructure layer, as you can see with the NVIDIAs and AMDs. A lot of work obviously is happening in terms of the models and of course the consumption of those models that's sitting on the hyperscalers. But as you see the app stack and the real work happening in enterprise, you're seeing now value creation coming towards a data layer, which is where we play. And you will see more of that happening. And that's pretty similar to what happened in the world of cloud before, where infrastructure went first and some of the other layers like data came later. And we are seeing that. And I see enterprises, it's not a matter of if. Everybody is doing. Now, they are not in full-scale production. They are basically what I call partial production, POCs, pilots. I look at towards the end of this year or beginning of next year, and 2026 will be a watershed year for true productions and enterprise segment in particular happening. And I'm seeing that as I talk to our customers across the globe, by the way.
All right, Amit, really appreciate you joining us. Amit Walia is the CEO of Informatica. They just reported earnings. The shares camped out right around 24.7, just below that $25 takeout price by Salesforce. As we continue here on the close, Vani, let's take a look at some of the after-hours movers. And we got some big ones there. You see at the top of the screen, one of the biggest decliners is Lyft. The ride-hailing company did report earnings, and we did see bookings come in just a touch light. Gross bookings at $4.49 billion, just a smidge below what the street was looking for. But there's been a lot of questions about Lyft and kind of whether it should be a little bit broader, whether it should kind of branch out more into food and things the way that Uber has. But you get this idea here that at least for right now, investors are a little displeased with the lack of growth.
Yeah, and of course you had the Uber expansion as well earlier today, and gross bookings rising more than anticipated and so on. And so that's, another reason why investors are punishing this stock, although I will say, it was up at the beginning very quickly.
And DoorDash there, you see that up about 4.23%. You said you don't use DoorDash, but a lot of people still do.
I'm terrified to use it again. I used it once. Also, did you see that viral Instagram where the guy was like, I worked 12 hours and I made $212 and I have to have my car tuned up and pay taxes?
I did not see that. Airbnb lower as well. Zillow unchanged on the day. We'll be back in a moment. This is the close on Bloomberg. All right, right now we're waiting to hear from President Donald Trump and Apple CEO Tim Cook. Apparently they're actually going to be together at the White House today to announce $100 billion in investments by Apple into its U.S. manufacturing build-out. Now, Tim Cook was just seen entering the White House earlier, and we are awaiting a public appearance by those two men momentarily. Let's bring Mark Gurman into the conversation. Of course, he covers everything Apple for us here at Bloomberg and helps to lead most of our technology coverage. And Mark, when I saw this headline go by earlier today, $100 billion, and we know that in the past they have actually committed to around $500 billion. When we talk about that extra $100 billion, do we have any sense of where it would go?
Out. Apple and Corning are partnering to manufacture 100% of the glass, the cover glass that's used on top of the display for the iPhone and the Apple Watch in the U.S. in Kentucky. This is a $2.5 billion commitment from Apple, and this will now see 100% of the glass used in iPhones and watches on the top of the devices made in the U.S. This is a major announcement. This is not mass manufacturing of any Apple product in the United States, but of course this is mass manufacturing of a very key component. When you think about what goes into an iPhone or an Apple Watch, you're using it through the glass, you're touching glass. So this is quite significant, a big partnership between Apple and Corning, and obviously despite this not being actual production of devices, this is still a big win for Donald Trump.
Kind of interesting, too. I'm looking through the release now, and we talk about that $500 to $600 billion that the company is committing overall to U.S. manufacturing. And the big question when we started to hear those numbers, Mark, was the idea, of course, of like how can you even sort of reshore a lot of that manufacturing capacity without significantly raising the cost of an iPhone. It's kind of interesting that they would start with something like a glass and something like a company like Corning, which has been known not only to make high quality glass, but to do it at a relatively cost effective way for its current customers. Do you think we can maybe see similar deals for other components in the iPhone?
Well, the glass used in the iPhone via Corning has been made in the United States for a number of years. What's unclear is how much of that glass has already been made in the U.S. Tim Cook for years has been touting that the glass is made in the U.S. for the phone. So it's going to be interesting to see what the actual delineation between what's been happening today and what's happening tomorrow actually is. But certainly, press release or not, Tim Cook speaking from the Oval Office or not, it's a big win for Trump.
Yeah, I mean, that's what I was going to say, Mark. I thought Apple already made glass through Corning in Kentucky. And does this speak to potentially, a disconnect between what the White House wanted to announce and what Apple was willing to promise the White House?
Well, Apple's promising the White House here something that it clearly is able to do. It's not promising any manufacturing or final assembly, which is what Trump really wants, right? And what some people really want, because that would be impossible. As we've been talking about for a number of years, you can't move production of the iPhone into the US at this point. It would take many years for something like that to be able to be accomplished.
Yeah, Mark, fascinating. Well, we're going to hear from the president and we're going to potentially see Tim Cook in the next little while as well, so we'll potentially know more then. Bloomberg's Mark Gurman with us. And our next guest says, quote, the love language of this administration is deals. Deals is how you gain favor. We saw this with NVIDIA, and that's the goal here with Apple. So let's bring in Doug Clinton, CEO and founder of Intelligent Alpha. Looks like we're getting a few more details about this $100 billion, Doug. It involves Glass, Corning, and Kentucky, which Apple already had a presence in. What do you make of what we've just been reporting?
I think that the theme, Bonnie, it's all about leverage. And if you were in President Trump's shoes and you're Tim Cook, Trump came to you and said, look, you have leverage over a lot of these suppliers who make components in your phone. You might not be able to bring those assembly jobs, actually putting the pieces together to make the phone back to America. But can you bring some of those components back to America? As Mark mentioned, it sounds like we'll have some expansion in terms of the glass that's made here with Corning. And I would be shocked if we didn't hear other deals from supply coming back to America, because it's sort of up to interpretation. What does it mean that Apple's investing $100 billion in manufacturing? I think it is unlikely that they actually have jobs here building the iPhone, but I think we're going to see a lot more deals like Corning where we make components here again instead of overseas.
Yeah, and of course confirmation from Apple as well that it's going to directly hire 20,000 people in the US over the next 4 years, 5,000 people a year. I imagine, Apple hires and fires many thousands of people every year anyway, but this is a particular promise, I guess, to the administration. In that sense, Doug, is this going to help Apple with the 232 investigation? Will it have any impact on that?
Well, I think what's the purpose of this deal if you're in Apple's shoes? Because if you kind of look at the math, right, an incremental 100 billion, 25 a year over 4 years, as you just mentioned, you're saving about $10 billion a year in potential tariff impacts if you can get a deal done to sort of circumvent or get an exception for some of your core products from these new tariffs, particularly the ones that were introduced in India, where the iPhone is made. And so the math, I think, says, well, this looks like kind of a lopsided deal where Apple might be paying a lot more relative to what it might be able to get back in return. But I think that might miss the point a little bit, because you also get pretty good diversification in your supply chain. And that's been something investors have been asking about with Apple for years now. How do you get away from Asia and bring some of those components back into America where maybe you have a little bit more reliability and certainty in that supply chain?
How much, Doug, though? One concern, though, is the reliability and uncertainty with regards to the U.S., meaning the administration, and the idea that a deal hopefully is a deal, that if Tim Cook agrees to whatever terms he's agreed to with the administration, they're going to leave him alone, or leave him alone enough where he can do what he is supposed to do. And I do think back to the first Trump administration, where Tim Cook was also kind of had his back up against the wall at one point, and everybody thought it was gloom and doom. And he turned out to be kind of the ultimate diplomat in navigating that administration. And I am curious as to your take on his value as a CEO, not so much as a by-the-numbers CEO, but really as someone who can navigate the geopolitics, not only of the U.S. and a president who is demanding, but of course of China and a president who is demanding there as well.
We see it as an insurance policy. I think that that's exactly the right way to view this, which is the love language, as we said, of this administration is deals. Hey, let's make a really big deal. We'll make a big announcement, and we will follow through on that deal. And in return, take care of us. And I think that that is what we will ultimately see here. Tim Cook, and I think like Jensen Huang at NVIDIA, have both seemed to be able to build a good relationship with President Trump and make these sorts of deals. I think you also obviously saw that with Oracle and OpenAI, the announcement around Stargate several months back. Mm-hmm. And so I think that if you are able to, in this tech space, sort of get on President Trump's good side, you make these big announcements, you follow through on them, I think he will take care of you in the end.
I do going to get your thoughts just about why Apple is such a laggard this year. I mean, amongst the Mag 7, it's basically the biggest laggard. I mean, Tesla is a little bit worse, but that's more of a self-inflicted wound than anything else. But I am curious if for a company that is just throwing off cash like all get out, has an ecosystem that I think any company would just kill to have, why don't you think you're seeing a better multiple on this stock and a little bit more euphoria in the same way that we see with the Meta and Nvidia and all these other big tech stocks?
You know, I think it's both obvious and frustrating. It's all about AI for Apple. They just have not shown the same innovation that we've seen from the Metas, the Nvidias, even the Googles. I mean, Google, Alphabet, they've been sort of a laggard. They've picked up a little bit of that AI story and tailwind over the past quarter. And I think that now that we sort of have this deal and likely, we'll see, we need another announcement probably, likely this tariff issue sort of behind Apple now, the question does come back to what will they do in AI? And I think unfortunately for investors, we really won't get a good sense for that. You know, maybe we get some nuggets in September when we get the new iPhone, but I think it's actually really all about WWDC in June of next year, because Apple said, look, don't talk to us about AI. I mean, they kind of took it off the table over the last few months. They need some time to really get it right. And that's where I think their backs will again be up against the wall. They need to deliver in June.
All right, Doug, great stuff as always. Doug Clinton is the CEO and founder of Intelligent Alpha. We're keeping an eye on Apple. Tim Cook set to meet with the President of the United States. We're already told that he is at the White House. We're waiting to hear from both of those men about this new commitment by Apple, an extra $100 billion on top of the $500 billion it's already committed to U.S. manufacturing capacity. This is Bloomberg. All right, a line from Wall Street to the White House with at least two major bank CEOs meeting with the president today. Citi CEO Jane Fraser is said to have met with President Trump earlier to discuss Fannie Mae and Freddie Mac, a potential public listing of those two mortgage finance companies that have been in conservatorship since the financial crisis. Bank of America CEO Brian Moynihan also reportedly seen at the White House, and this comes just a week or two after we saw the CEOs of Goldman Sachs and JP Morgan also meet with the president. Todd Gillespie of Bloomberg News joins us right now for more. And this is all about taking Fannie and Freddie public again? Is that what this is about?
Apparently so, Romain. Yeah, I mean, 2 weeks ago, the Wall Street Journal came out with a story saying something about Jamie Dimon, Donald Trump meeting again, having some kind of entente cordiale after months and months of not being super happy with each other. One thing we did eventually learn that actually the real purpose of this meeting and the purpose of these many meetings that are now coming is that Trump has asked these CEOs explicitly to come meet him in Washington one by one, not at a business roundtable, not at a sector group, not at a trade group of the banking industry like he normally would, but actually one by one to come and pitch him on this massive bake-off, basically, for one of the biggest bake-offs in U.S. history, potentially, to make these massive mortgage giants that were nationalized essentially after the
fascinating. And presumably they can't talk to each other, right? There can be no collusion before they pitch the president. How much, though, can he or anyone in his staff, you know, decide how this goes down before involving Congress in some way? Yeah,
right now, the FHFA, which is the government agency that is responsible for this, they have been working out in the background. They're an executive agency, so they're basically under the direction of the president. They've been working on plans for a while, even since the last Trump administration. Trump actually, hired another investment bank, Houlihan Lokey, to advise on the government side back in 2020. So this has been rumbling along in the executive branch for a long time, and there's a lot here that's still to be planned out.
We're talking, at least when we talk about the value of the mortgages, book values, we're talking in the hundreds of billions, maybe even to the trillions, if my math is correct. That's not an IPO, or assuming to take these two IPOs, or whatever we're going to call this. That's not something one bank can do alone. Even a bank the size of JP Morgan, Goldman, this is going to be a syndicate in some way or another. So why call these people one by one? Because my guess is whenever this does come to market, you'll probably see Goldman's name, JP Morgan's name, and maybe a couple other banks on that list too.
Quite possibly, yeah. But you want a lead underwriter, right? You want someone, potentially this is going to be done in stages because it's so big. You've got Fannie and you've got Freddie. Remember, some of this stock is already public. A small portion of both of these companies already do trade publicly. Their shares actually shot up after our report last week that this plan was actually underway. And now this is just a sign again that Trump is clearly serious about doing this after months of tweeting it out on Truth Social or whatever he does nowadays.
All right, Todd Gillespie of Bloomberg News, a closer look at Fannie and Freddie. Some breaking news crossing the wire right now, also related to Apple and that investment here in the U.S. We're now learning that Applied Materials is working with Apple and Texas Instruments to invest over $200 million in Arizona. This is to both semiconductor manufacturing, Bonnie. And it really gets to this idea of a president who came into office and made it clear to a lot of the U.S. CEOs here, and for that matter, foreign CEOs as well, that if you want to do business with the Trump administration, you got to do business with America.
And Applied Materials shares are rising. The aftermarket up 1.6% now on that news.
We are still awaiting public appearance by Tim Cook alongside Donald Trump, where we can learn some more details about that commitment that Apple is making to this effort. The press release that we got earlier suggested that Corning, the glass maker, is involved in this as well, and now headlines on Applied Materials bolstering its semiconductor investment as well. The team at Balance of Power, they're going to pick up at the top of the hour and bring you all those details right here on Bloomberg.